Hey, welcome back everyone. And if this is your first time here, you're going to find a lot of videos about home finance, mortgages, real estate, if you're a homeowner, any way to save money at home, buying and selling homes, things like that. Hopefully that'll interest you, and if so, hit that subscribe button and check out more of my videos. So anyhow, this video is about USDA mortgages. And a USDA mortgage is a government-backed mortgage. There are three of the most common mortgage government-backed mortgages are VA loans, FHA loans, and USDA loans. And so a lot of people don't know about the USDA loans. I'm going to take you through what they are today and how they could be beneficial to you and why I think that they're a really good loan program. And then I'm going to be able to, at the end of the video, provide you with some additional resources where you can find out more. So first, I'm going to give you the basic bullet points on what USDA loans are all about. The most important thing is that that people focus on is the fact that they're a zero down, no down payment mortgage, which is great for people that either don't have the down payment money or they would rather use that money towards something else. That's the primary benefit. The other aspect of it is that they're for homes that are located in rural areas, and I will get to that further down in the video. So set that aside for the moment. They're insured by the government. They do have great rates. In fact, I did some checking with one of our lenders, and USDA rates are a little bit better than FHA right now. And they're also, the other thing you need to know, they're for low to moderate income households. I'll get into that as well in a minute. So now the first thing you need to know is, or how do you qualify? What are the criteria? The amazing thing is that there are a couple of lenders that will finance your home with a USDA loan with credit scores as low as 500. It's possible, but you're going to need a lot of compensating factors. I'll get into that in a moment. And also the rates are not going to be great. The worse your credit score is, the worse the rates are. So that's really going to be the case with any mortgage, but you could be paying a big penalty or premium in your mortgage rate if you've got credit scores down in the 500s. There are a handful of lenders that will approve you with credit scores below 600. You can't have a recent bankruptcy or foreclosure or short sale within the last 3 years. So if that's the case, you won't qualify for one of these mortgages. You need to have steady employment and income for the past 2 years. It doesn't mean you have to have been in the same job for 2 years, but you needed to have a job at least for 2 years straight. And if you had a gap of, say, a month or more, you're going to need to provide a letter explaining what the gap's all about, and hopefully the underwriter at the lender will approve it anyway. The debt-to-income ratio, or the DTI, the typical maximum is around 40 to 42% in that range, but you could get it up to 46% with compensating factors. You keep hearing that from me. I'm going to tell you what that is in a minute. And you need to have at least 2 months of reserves. Reserves are your mortgage payment, including your taxes, principal, interest, and homeowner's insurance all bundled together. You're going to need to have at least 2 months payments set aside after closing. They want to make sure you have the ability to make 2 months worth of payments in the event that you lose your job. Okay, so I talked about compensating factors a couple of times. And I also have a video about compensating factors, what they are and how they impact your mortgage. I'll try to link to that in the end or down below or in a card here or something to that effect, so you can, or just search my channel, you'll be able to understand more about what that is. But basically it's when you're deficient in one area, meaning your credit score is a little lower, or I just talked about your DTI is a little higher. There'll be another compensating factor, something else about your portfolio that's a benefit that helps offset that negative. Okay, so for example, even though it's a zero down program, a great compensating factor is if you have a lot of cash, you have a lot of money in the bank. That gives the lender some confidence that you'll be able to make your payments even though you have a low credit score, or even though you might have a gap in employment. Okay, so that's a terrific compensating factor in the case of a USDA loan. So let's talk about the property itself. I'm looking down here at my cheat sheet. It needs to be in a USDA approved area. So you might think, well, the houses I'm looking at, I don't think they're in a rural area. I mean, it's not a farm, but you'll be surprised at where USDA delineates what's rural and what is not. And I'm definitely going to provide in the link below an article, and also probably I'll pin in the first comment an article to where you could read more about USDA loans and also get a link to search a property address to see whether it falls into one of the USDA approved areas. And when you do that search, you'll see a map, and you might see an area of the map that'll highlight as orange. If it's orange, it's not eligible. If it's outside the orange area, it is eligible. And once you put the property address in there, it'll actually tell you whether or not that property is located in an eligible area. And once you have that map up and you're interested in looking at homes in that particular town or the general geography, you could zoom out and kind of look at it and target certain streets even that you can see on the map are already within the USDA eligible area for an approved home. So that'll help you if you absolutely need a house with a zero down mortgage. So the other thing is that the property has to be your primary residence. Okay, you cannot buy it as a rental, and the property cannot be used for any income purposes, meaning even though it's a rural area, it cannot be a working farm where you're using it to make money. So it just has to be a home and your primary residence, and it can't be a multifamily building that you're renting out. Okay, so hopefully that'll explain that. It's it's pretty simple to follow, I think, but if you have any other questions, just leave them in the comments below on that part. Okay, so employment and income is my next section. I'm whipping through this. Hopefully I'm not skipping anything. Again, I'll answer any questions you have down below on the property piece. Employment and income. I just referenced that you need to have steady employment for at least 2 years. There are a couple of exceptions to that. So for example, if you were in college, let's say you graduated college 1 year ago or 6 to 8 months ago, and you immediately got your first job out of school, and you're gainfully employed, and you've got paychecks coming in. If you're a full-time student, that's a good enough excuse to not have 2 years employment. If you were serving in the military, that's another example of an excuse where you don't need to be fully employed for the last 2 years. So those are two perfect examples that would work. The other thing is that I talked about income. There are income limits for USDA loans, and where with the other mortgages, all the other mortgages, there really isn't an income limit. You can in fact, making a lot more money helps. It's one of those compensating factors that I spoke about, and I didn't bring it up as a compensating factor here with the USDA loan because they have income limits. So the income limit will be anywhere from $86,000 and change up to a few $100,000, depending on the geography. So what county the home is located in, how many members in your will reside in the household. So there's a formula, and also in the article that I'm going to be linking to at the end, there not only is a link to look up the property address, but there's also a link you can click on to determine what the maximum income is going to be for you and the entire household. And so when it comes to whether your total income qualifies, it's not just the income that you as the borrower make. So let's say you're married and it's just you that's going to be on the mortgage, and your spouse has a job, a part-time job even, and you don't want to put your spouse on the mortgage. Well, the USDA requirements are that the lender look into all of the income within the household and add it all up, even though the other individuals are not applying for the mortgage, and the combined household income needs to be taken into consideration to determine whether your income is too high to qualify for a USDA loan, okay? And one of our USDA lenders can take you through that if you have any more questions. So mortgage insurance, you're going to have to pay mortgage insurance. And the mortgage insurance is going to be less than traditional PMI, a lot less than FHA mortgage insurance, and it's fairly reasonable when you compare it to the other two. It's 0.35% of the loan. As I record this now, I kind of hate throwing numbers like that out on a video, because by the time someone watches this a year from now, the guidelines could have changed. We are updating those guidelines in that same article down below. But yes, you're going to have essentially PMI or mortgage insurance for the USDA loan, because you're putting down, nothing. Okay, so it's essentially an insurance policy in case you default. There's also going to be a funding fee of 1% of the loan amount. Okay, so let's say you're purchasing a home for $100,000, and the funding fee is going to be $1,000. The good thing though is that you can roll that $1,000 into the loan amount. So if you're purchasing a home for $100,000, you have a 0% down payment, a 1% funding fee. Your loan amount will be for $101,000. Okay, so you can finance that funding fee. Another positive is that the lender will allow you to roll closing costs into the loan if the property appraises high enough to cover it. So let's use that $100,000 purchase again as an example. Let's say the house appraises for $108,000, right? And you just included $1,000 for the 1% funding fee into the loan. So now you're at 101. The property appraised for 108. There's room for you to also include another $7,000 worth of closing costs into the loan amount. Now, I don't think there'll be $7,000 worth of closing costs on a $100,000 purchase. However, if there was, and let's say you needed to pay points to get the rate down because you have a very poor credit score, you could finance all of that up to $108,000, because that was the appraised value. Hopefully that makes sense to you. And another reason why this is a really great loan program. A lot of people don't know about USDA loans, and of all the inquiries we get, USDA is about 1% of all the loan inquiries, and sometimes we're having to recommend it. We ask the property, where's the property address? And then after plugging the property address into the property lookup tool for the USDA, we might notice, wow, this property and this borrower might be eligible for the USDA program. The only thing that we have to look at is where's the credit score, and hopefully they don't exceed the income limits. So it's really a great program. Hopefully this gave you a great starting point about USDA loans and what they're all about. And any other questions you have, leave them in the comments below, or just email us at the website, and we'll get back to you, answer any of your questions. Hopefully this was informative to you, and if so, please hit that subscribe and bell notification icon. Like the video is actually more important than subscribing. YouTube likes for whatever reason. And thanks for joining. We'll see you next time.